On today's video, we're going to go over the investment secret that the ultra wealthy use to pay almost nothing in taxes. Hi, I'm Kevin Kroskey. I'm a certified financial planner, founder and CEO of True Wealth Design. We're a wealth management and business advisory focusing on tax and accounting work for our clients, serving people nationwide from our offices in Northeast Ohio and Western Pennsylvania. So the title is definitely a little bit marketing foo-foo, right? Hey, the ultra wealthy, the secrets. I didn't write it, my marketing professional did, but here's what I'm going to share with you. It's significant, it's substantial, it exists. It's you can do this through custodians such as Schwab and Fidelity, so it's past their due diligence. Otherwise, they would not be holding these sorts of investments that can produce these sorts of results. So, of course, disclaimers are going to be there. Consult your tax advisor, consult your attorney, what have you, or give us a call and we take on that liability because we stand behind our work. But what are we really referring to here? On many of our prior episodes, we've talked about TALs, tax-aware long-short investing. The long-short is the investing component. The tax-aware is really how it is executed from a trading strategy to produce tax assets. I'm not going to go over those details in this video. You can see our other content related to it. But here what I'm going to focus on is, suppose that we've been using TALs. We've created these tax assets, these net capital losses through a good sound investing process and a tax-aware trading strategy that goes ahead and produces these tax assets for us. We've accumulated them. Now, what are we going to do with them? Well, here's where we're going to get into something for the SEC qualified purchasers. Those are people with $5 million more in liquid investments. It can also include some investment real estate. So you have to be in the pretty rarefied air for this to work for you. But candidly, not only do we have a fair amount of people that are already in that bucket, we have a lot of people that will be on that path. They could be high income people. They could be two-doctor families that are working and saving and doing really well. It could be business owners that will reach to that point. We have several clients that retired, very well. And despite our best efforts, they're not spending their money as much as we nudge them to do so. They live below their means and compounding works its wonders. So they can end up in that category too. So if you're on a path to go ahead and get to this standpoint, this video is for you. Or if you're there already for that matter, can apply to you right away. So what we're talking about here is going into a specific sort of structure. The structure for this sort of TALS investment, it's not a regular brokerage account that's going to produce a 1099. It's a limited partnership investment. Hedge fund is kind of a broader term for it as well, that we can go into and we can invest in as long as we are SEC qualified purchasers. And in that investment structure, the structure matters. It's taxed as something called a trader fund. Now, the trader fund status allows us many benefits. What I really want to focus on is that it allows us to go ahead and have losses, and it can flow through our tax return regardless of material participation. So this is something that you may be familiar with if you own real estate. If you own real estate, it tends to be passive. So it creates passive gains or passive losses. It's under the passive activity section of the Internal Revenue Code. And most times passive losses can only offset passive gains. There could be some exceptions to this. If you're a real estate investor professional status, there's different short-term rental loopholes that you can go ahead and legally pursue as well. However, there's all our requirements to doing this. And candidly, most busy professionals can't qualify for them, and there's risk in trying to do so. TALS is different. In this structure, in this limited partnership investment, the material participation doesn't matter. It's at the trader fund status that basically negates having to go ahead and put in an hour requirement. So these losses can flow through to you. I know you don't want to lose money when you're investing, right? Again, markets are volatile, may lose money is always kind of a disclaimer. You have to take risk to go ahead and pursue a reward. But we're not talking about intentionally losing money. We're talking about using the tax assets we created in TALS to go ahead and couple with this LP strategy in the trader fund. Again, that's how it's going to be tax reported. Within the hedge fund, they're using certain investments that produce some interesting tax attributes. Here, really what they can do is bifurcate capital gain and business loss within the strategy because it is a trader fund. And because of how the swap contracts that they're trading are going to be taxed and reporting. It's an important note that what we're talking about here isn't something that's very risky from a tax perspective. Again, everybody has their own level of riskiness or not, but we're talking about holding these investments through a platform like a Schwab and Fidelity. It's past their due diligence. They're not recommending the investment, but they're certainly not going to put something on their platform that they want to potentially get sued for. So it meets their criteria to be held on their platform, or at least reported through their platform, I should say. Additionally, in terms of the K1 that comes out from these limited partnership investments, it's not some fly-by-night CPA firm. The one that we predominantly use for this investment is KPMG, one of the big four CPA firms that's preparing the tax return and issuing the K1. Again, do you think that they're going to risk the reputation and business to do this if it was fraudulent? Of course not. So that's an important side note. But what happens on that K1 is that you'll have basically short-term capital gains and business losses that are reported. These swap contracts can be managed in a way where basically those two tax attributes can be bifurcated in a very sophisticated manner and flow through to you as the investor in the limited partnership, in the hedge fund, and receiving that K1 with this interesting tax bifurcation. So if we've created tax assets through a TAL's brokerage account, these net capital losses, again, what I call tax assets, now we can use it in combination with this hedge fund strategy, the TAL's LP is what we prefer to call it, to offset the capital gains that are being realized in the LP. So the capital gains and capital losses can be netted out. And now what we're left with flowing through on our tax return are business losses. What a game changer. Now we don't have to be a material participant, spend at least 500 hours or 100 hours materially participating in some of these strategies to go ahead and get not passive loss treatment, but allow those to flow through to us and take against our ordinary income. Here, those requirements don't have to be met because of the trader fund status that is being reported. So those business losses can flow to us. If we have a business, if we have a positive K1, that K1 income can be offset. If you have a seven-figure K1 income, here we're talking about incredibly significant tax avoidance done in a legal manner. What if we don't have a K1, or what if you don't have sufficient K1 income to go ahead and offset and use all those losses? Well, here too, we can benefit. Subject to rules. They're called the excess business loss rules. And here in 2025, it's $626,000 that we could go ahead and deduct against our non-business ordinary income, things like wages, interest, bonuses. You can go ahead and have non-qualified dividends, royalty payments, for example. All of that is taxed at your highest rate, which is going to be higher than your capital gains rate. So when you have those losses flowing through, it can result in significant tax savings. Now, we have a few things on our site that will help. And if you look in the description link below the video today, there'll be a link to take you to our site. One is the Tax Aware Investing Guide. That'll go through this in some more detail. And when you go to that screen, if you look at the top right, you'll be able to see a green button. If you want to go ahead and schedule a call and explore this and learn more, ask a financial question, click that button. If you want to get in more of the weeds, if you're one of our beloved engineer type clients, if you're sophisticated, if you want to run this by your CPA, go ahead. Candidly, I wrote a very technical article. Again, warning, technical article that's on here. When you take a look at it, it's called Tax Aware Long Short Tax and Investment Strategies. Again, mouthful, TALS for short, understanding business loss deductions. Now, when you go and you check this out, what you'll see there will be a case study. So let's just highlight a few things here. You can read it for more details. But here we're talking about this couple has W-2 income of $300,000. They do have a business that they're operating, which produces a $700,000 K1 for them. Here we're also assuming that they're going to do a $500,000 Roth conversion. They already have $1 million of W-2 and business income. Now we're adding another $500,000 of income, ordinary income, converting that income into a Roth. $1.5 million total in ordinary income at this point. What we're going to say here is let's assume that we've been using TAL strategies for years, building these tax assets, and we have $2 million in net capital losses already accumulated. Now we're going to go into the TAL's LP, into the hedge fund. We go ahead and we do that. This hedge fund produces a $2 million ordinary loss, a business loss on the K1. The ordinary loss is subject to these excess business loss rules. So what does that mean? Well, we look and see what's our business income, the 700,000, that is fully offset. Our wage income, again, not business income here, we're talking about wage income. We have a $626,000 allowance in 2025 for a married couple filing jointly. That $300,000 is fully offset. We have an additional $326,000 now that we can use. And here we see that could be used against a big portion of that $500,000 Roth conversion, making your net amount taxable only $174,000. So the net result for 25 is $174,000 taxable ordinary income. $674,000 is carried over now as a net operating loss. So this excess business loss converts into a net operating loss. Are we getting in the weeds? Yes. Is it complex? Yes. Do you need to know how to do this from an investing and tax standpoint? Absolutely. This is not something that you're going to DIY here. And candidly, it's something that most advisors aren't aware of or cannot effectively implement at this standpoint. We've done many implementations over the last 2 years. We're definitely more on the leading edge at this point in time as I sit here in October 2025, and we're happy to be there and we're happy to be adding these benefits for our clients. Now, if we carry on down into year two, let's assume same income, but let's just take TALS out of it for this year for simplicity and show what happens as that net operating loss is carried over. So they have $300,000 in W-2 income. They have $700,000 in K-1 income, no Roth conversion income, no TALS income. Again, just keeping it simple and straightforward here. Now, if we go down to the table, so again, we have the business income, we have the W-2 income. There's $1 million that's there. $674,000 can be applied. Candidly, when we have the net operating loss, it does not matter the type of income when we're applying the NOL. So here, again, the tax planning changes yet again. So we need to be mindful of this. Now, $674,000 can be applied. It's up to 80% test, meaning 80% of taxable income can be offset by an NOL. If the loss amounts were higher, say we have $1 million loss, only 800,000 of that could offset the $1 million of income. So these all things come into play here. Again, it's a multi-year approach, not only for your investments, but for your tax planning too. When you look at it overall, the federal tax savings, this is kind of a bit of a jaw dropper. Year one, without TALS losses, taxable income would have been $1.5 million, resulting in approximately $499,000 of federal taxable income. With TALS, $29,963. Is it zero? No. Could it be zero? Properly designed, it could be. Now, look, we'll let you make your own judgment how much you want to pay in taxes, but certainly you can always donate money. You can charitably donate money. You can donate money on your tax return, probably one of the most unused lines on the tax form in history. But these are ways that you can go ahead and legally avoid taxes through both good, sound investment planning done in a very sophisticated tax smart manner. When you get into year two, if you look at the combined savings, rather than paying $296,000 of tax in year two, that's reduced down to $63,000 and change, $232,000 of tax savings. We're talking about $700,000 plus of tax savings over 2 years for this situation. Now, these are high income numbers. I get it. Maybe this applies to you, maybe it doesn't. But creating these tax assets makes sense for any taxable investor that is not going to spend down their taxable assets quite quickly. They're going to be there and grow and compound. If you're a business owner, if you have high K-1 income, if you're a surgeon, orthopedic, if you're in radiation oncology and just crushing it, if you're a high income professional, these strategies can work for you. Sure, ask your advisor if they can help you. I would be willing to bet that this is going to be new to them. And importantly, this is not just something that any CPA firm is going to be able to do from a tax filing standpoint. There's a lot of complexity here. It needs to be thoughtfully implemented and coordinated. We've been doing it for more than 2+ years at this standpoint. And if you're interested in learning more, we're happy to talk to you too. As my 2 young girls always remind me, Daddy, be sure to tell them to like and subscribe. If you found this content valuable and you don't want to miss future episodes, please do subscribe. And if you like the video, please do like it as well so we can share this content with others. Go into the description. You'll see the link there to go ahead and get the free guide on our website. And if you'd like to schedule a call, you can do that too.
Information provided is for informational purposes only and does not constitute investment, tax, or legal advice. Information is obtained from sources that are deemed to be reliable, but their accurateness and completeness cannot be guaranteed. All performance reference is historical and not an indication of future results. Benchmark indices are hypothetical and do not include any investment fees.